Hello everyone, and thank you for watching my videos. Investors are always studying many different currency pairs, and they're always paying attention to the movement of the prices. You see, many investors are looking for breakouts. Breakouts are a very interesting way of determining how much potential there is to receive large amounts of profit. You see, when the markets head in a general direction, meaning either heading upward or heading downward, breakouts just means that the market has switched its direction. Or when the market is heading sideways and there's not too much action in the market, the volatility is low, sometimes one of the candlesticks breaches the line of resistance or support, and then a new trend ensues. So breakouts are very important because they can tell us how much profit we can make when we enter the market at that time. However, in order to predict breakouts successfully, we have to measure volatility. Now, the Forex market has many advantages over the stock market. However, there is one disadvantage with the Forex market, and that is we can't measure volume. Now, unlike the stock market in which you can measure volume, the Forex market can only measure volatility. And we measure volatility by using the tools on our trading platform. So, volatility just means how much action is in the market, and also how much noise is in the market. And if you watch my video on Bollinger Bands, they can give us the information as to how much noise and how much activity is involved in the market. Because just because the market is ranging doesn't mean the market is quiet. It could mean that the bears and the bulls are battling for control, and the intensity of that battle can determine whether or not the market is going to break in either a bullish direction or a bearish direction. So what we need to do is we need to be concerned with how much volatility is in each currency pair, because the amount of volatility can give us the advantage. And it's better to measure these breakouts or look for breakouts when volatility is low rather than volatility being high. Okay, so what I want to do right now is I just want people to realize the difference between volume and volatility. Okay, so again, volume just refers to how much has been traded. Volatility just refers to how much action is taking place in this market. So, how do we measure volatility? Well, there are many different ways. For example, we can use volatility when we're looking for breakout trade opportunities, and we can use the tools on our trading platform to determine how much volatility. For example, here we have moving averages on this chart. Now, the moving averages will tell us whether or not we have a breakout ensuing. So as you can see, we have a slow moving average and a fast moving average, and the market was ranging. So when we see the market ranging, we notice that the two moving averages are close to each other. And then we had a crossover, and look at the bearish candles going down. And here we have another crossover, and so we had somewhat of a small bullish trend, but that trend was pretty much weak. And then we have the market ranging again. So as we can see, moving averages, they tell us the average price movement over a period of time, just like I explained in the previous video. So we can also use moving averages to determine how much activity is in the market. So by using moving averages, we can determine which direction the market is going to break out and when would be a good opportunity to get into that market and to realize how much profit we can make when we go long or when we go short. Okay, also we talked about Bollinger Bands in one of my previous videos. And again, Bollinger Bands works like this. When the bands are closer together, there's not too much activity in the market. As we can see here in the middle of the part of the chart, the bands are very close to each other and the candlesticks are very small, which means there's not too much activity in those sessions. The Bollinger Bands spread wider apart as the candlesticks get bigger, and bigger candlesticks means more activity. So use Bollinger Bands in order to determine how much volatility. Use Bollinger Bands to determine how much activity is in this market. Now, we talked about average true range. So here we have our candlestick chart, and on the bottom we have our oscillator chart. So if you notice, when the average true range is high, that means there's large amounts of activity. But when the ATR is low, there's not too much activity. So notice that the size of these candlesticks corresponds to the high ATR. And the size of these candlesticks that are ranging in between the two lines of support and resistance, they correspond with the low ATR. So keep that in mind when we use average true range, one of the tools in our trading platform. Now, let's talk about the different types of breakouts. So we have continuation breakouts and we have reversal breakouts. Continuation breakouts just means that the market has been bullish for a certain period of time, and then the market starts to range, and then the market picks up its bullish trend. Same with the bearish trend. So bearish trend, downtrend, the market ranges, and then downtrend again. Reversal breakouts, well, it just means the market reverses. Bearish trend becomes bullish. Bullish trend becomes bearish. There's nothing else to say about that. Okay, so for continuation breakouts, here's what it looks like on the chart. So as we can see, the market has been ranging for some period of time after the downtrend. Now, what happens after the market has been consolidating? The market continues its bearish trend. That's a continuation breakout. Reversal breakout works like this. After the market has consolidated, after its bearish trend, the market is now bullish. Reversal breakout. Okay, also we have false breakouts. Now remember, when we look at each trading session, sometimes we get some special information or even some misinformation in one trading session that can cause a spike in the prices. So don't get fooled when we see false breakouts. And also, if you remember on the video that I did about moving averages, we do have those fake outs. So be careful. We do get false readings in these markets. Okay, so again, false breakouts occur when the price breaks at a certain level, and also sometimes the line of resistance or support, they get breached, but then they eventually fall back in line and settle around the middle of resistance and support, which is where candlesticks tend to gravitate towards when the market is ranging or when the market is channeling. So as we can see, we have a period of consolidation. However, a bullish candle breaks that line of resistance, which makes it appear that the bullish trend has begun. But that's just the buyers testing the market. But the sellers stepped in to push those prices down. So again, we're talking about a tug of war between the buyers and the sellers. So watch out for that. So here we have a bullish trend. And it appears that the trend line has been breached, which is functioning as the line of resistance. So we think that because the line of resistance has been breached in a downtrend, that the market will now be bullish. However, we have to be careful with false breakouts. So don't get too impatient. Wait to see what happens when these lines get breached, because they may break for a short period of time, but then they fall right into the channel. So usually when investors, when they see candles just outside the lines of support and resistance, they'll wait and wait until they can confirm whether or not the line is permanently broken. So patience pays off. Now, how do we spot breakouts? It works like this. So let's look at some chart patterns here. Double top bottom, head and shoulders, triple top bottom. Now, we've covered these in the previous videos, so I'm not going to spend too much time in this video covering these. But if you want more information, I suggest that you go back to the previous video on candlestick chart patterns. Okay, trend lines. We spent a lot of time in the previous videos talking about these. So again, here we have a falling trend line. What do we see? We see lower highs. And we see that the lines have been tested 3 times. And we see tweezer tops during the second time the line of resistance has been tested. So, what's going to happen now? Now we have the rising trend line. Just like the downtrend, the line of support has been tested, and here we have a bullish candle breaking that line of support, which has been functioning as the rising trend line. So this is our breakout, and now the bearish trend has begun. Now, notice on the bottom, here we have our histogram from our MACD. Notice that we had the crossover, and the 2 lines were high on the oscillator chart, giving us a signal that this market was overbought. Okay, see how everything is coming together? The signals of a market being overbought, crossovers, and the direction in which the histogram bars are pointing. All this information is coming together in order to get really strong readings on these charts. So use the information that I've been giving you in the previous videos. This will help us get a strong advantage when we're investing in this market. Okay, so again, the breakout has been confirmed by the MACD. As we can see, the direction in which the bars are pointing and the crossover in the overbought zone. So, now let's talk about channels. So here we have a rising channel, and notice that the candlesticks are staying within this channel, although the lines of support and resistance have been tested in several areas. And then here we have a breach in the line of support, and now the bearish trend has begun. Now if you notice, at the spot where the line of support has been breached, we see a crossover. And where we see a crossover, we see a change in direction in which the bars are pointing. So remember, we use oscillators to help us find these breakouts. And by catching them early, we can make large profits when we go short on these bearish trends. Okay, now triangles, more about patterns. So as we know from the previous videos, there are 3 types of triangles: ascending triangles, descending triangles, and symmetrical triangles. So again, let's look at these types of triangles. So here we have an ascending triangle. Notice that the line of resistance is flat across the chart. However, we have higher lows, and it looks like that the line of support is going to cross over the line of resistance. So, and what happens when we see that? Well, many investors assume that is a buying signal. So many investors will go long, may go long, as the point of the triangle gets nearer and nearer and nearer. Okay? And now if you remember from the previous video that I where I talked about triangles, ascending triangles, many investors take that as a bullish signal. Descending triangles works the opposite. So it looks like the line of resistance is not as stable as the line of support. And it looks like the line of resistance is going to breach the line of support, which gives the indication that the market is going to go down in price. And it does. So again, we look for these signals to determine where the breakouts might take place. And then symmetrical triangles. Here, the lines of support and resistance both have the same amount of stability, but sometimes it may be difficult to determine which direction it heads in when both lines of support and resistance are equally stable. So, the price might break up or it might break down. Who knows? So, what do? We place two orders. Meaning we place a pre-order right above the peak, and we place a pre-order right below the peak. And with each pre-order, we also place a stop loss. So what happens is one of the levels has been hit, that other order that we made has been canceled. So when we see this pattern, we can do this. We can place two orders, but have one cancel the other. And if for some reason the market reverses itself, we have our stop loss. So we don't lose too much. However, many investors feel that a strong trend is about to ensue. So many investors are confident in the fact that if the market does break the line of resistance, then the bull market will shoot the prices upward. And many investors will enjoy a large profit when they do that. Okay, so a little bit more information about the triangles. Ascending triangles are usually break out to the upside. So again, when we see ascending triangles, that gives us an indication that the market will be bullish in the future. And when we see descending triangles, that gives us an indication that we should go short in the future. Now, when we see symmetrical triangles, it's a toss-up, 50-50. So just be prepared for when it breaks up or down. Place those two pre-orders, but have one order cancel the other. So how do we measure the strength of a breakout? See, this is important because a strong breakout tells us the size of our profit. So, and again, we use the tools in our trading platforms to do this. So the price could continue in the same direction. Again, that's a continuation breakout. Or the price can reverse itself, which is a reversal breakout. So remember, we're learning about continuation breakouts and reversal breakouts. Okay, so again, we're going to use the MACD in order to measure how strong the breakout is. Why the MACD? Because they have histogram bars, and large bars determine how strong the market is. So notice that, let's look on the left here. Notice that the bars are small. And here, we do have somewhat of a trend, but it's a very weak trend. Notice that the bars are large as we progress, and notice that the bullish trend has gone strong before it's ranging on top here. So, and again, price moves higher on the candlestick chart. However, the MACD is heading in the opposite direction. So remember, so we have higher highs on the candlestick charts, and we have lower highs on the oscillator charts. That is called a bearish signal, and when investors see this, the market will head in the downward direction. So remember, higher highs on the candlestick charts, as indicated here, and lower highs on the oscillator charts. That means a bearish trend may or probably will likely ensue. So now let's use RSI in a breakout. So RSI, it's another momentum indicator that's useful for continuing reversal breakouts. So we use these in the same fashion as the MACD. It's just that it gives us the reading in a different way. So as we can see, we have higher highs and we have lower highs. Now remember, higher highs in the candlestick chart, lower highs on the oscillator chart. That's an indication that the prices will drop in the future. So we can use RSI as well as MACD. And again, if we look here in the circles, we can see that the RSI tells us that the market is overbought. So again, we're comparing price and momentum, if you remember from the previous video. Price and momentum plus the indication on the RSI that the market is overbought. So that can also help us determine breakouts. So now how do we trade fake outs? So remember, fake outs generally kill the investments made by amateur investors. So we want to know how to prepare ourselves just in case we don't have a real breakout, but instead a fake out. Well, if you notice, here we have a bearish trend. And notice that the market has been ranging from some time. However, we see some new bullish candles breaking above the moving average. This means that the market may be bullish in the future. This is an indication that the market may be bullish. Oh no, what happened? The market has continued its bearish trend. So what did we do wrong? Well, here's what went wrong. Support and resistance levels are areas in which their predictable price response can be expected. So we didn't read our information properly. So again, amateur investors need some time and some experience in order to develop the skills that are needed in order to make successful trades like the professionals do. So again, time and experience in which we can get when we trade with our virtual accounts before we trade with the real money in our real accounts. So keep that in mind. Now, support levels. They're areas in which buying pressure is just enough to overcome selling pressure and halt to reverse a downtrend. So again, we have to use more than just technical analysis. We have to use some fundamental analysis as well. So we have to check to see what news we've been getting during that trading session or what happened in the trading session. And again, a strong support level is more likely to hold up even after price breaks a support level and provides traders a good buying opportunity, or vice versa with the resistance. So again, we have to look at all of our information properly and weigh everything instead of looking at things partially. Okay, so let's talk about fading breakouts. Fading breakouts just means trading in the opposite direction of the breakout. Okay, and then also you would fade a breakout if you believe that the breakout from a support or resistance level is false and unable to keep moving in that same direction. So if you believe that the breakout is weak, then that can also be considered a fading breakout as well. And also, if the resistance level is broken, then people believe that the price is more likely to rally even higher and will tend to buy rather than to sell. Okay, so again, we have to examine these breakouts, look at them very closely to determine whether or not it's worth getting involved. And if it's not, then just wait for the next breakout. Okay, so here we have a downtrend. Notice that the highs are getting lower and lower and lower. And notice that the trend line, or in this case, which is functioning as a line of resistance, has been tested. Also, we had a little breach by one of the wicks of the candles. And also notice that it appears that the trend has reversed by a complete breach of the line of resistance, but the trend has not followed through. So the candlesticks are back right under that downtrend. So this is considered a fading opportunity. So how do we trade when we see these lines? Well, we just be patient. We just wait. Because if we jump into the market as soon as one of the lines of resistance or support has been breached, then we might be making the wrong decision. So when we see a break in the trend or a break in the lines of support and resistance, be patient, wait, see what happens after that breach. And if we see that the trend is for real and we compare that with the information with our oscillators, then we can go forward and go long or go short on the trade. So in this case, it does pay, and it paid significantly to go long and to wait to go long after that line has been breached. Okay, so here where I have the blue arrow, I'm pointing at the breach, and here's what we need to look at. So here we have a couple of patterns, okay? We have the head and shoulders, and we have the double top and double, or in this case, the double top. Now, as we can see right here, we have the candlestick chart patterns, as I mentioned in the previous video. So that has given us an indication that the trend will change. Okay, so again, we have the head and shoulders, just like I explained before, and it's a reverse head and shoulders because we're talking about a bearish market. And then here we have the neckline, as I explained before, and the market continues its downward trend. So again, when we see that pattern, it pays to sit back, see what happens, and maybe from using the experience and what we've learned from the previous videos about how to read patterns, maybe just sitting back to see what happens, and then once our predictions have been confirmed, then we can go forward and enter an open position in the market. Okay, so again, here we have the double top, here we have our neckline, and when we see the candles touching this neckline, what we can do is we can open a position right above or below that neckline and place a stop loss with the same distance from the neckline as they open. That way, if we're wrong, we don't lose that much of our capital. So again, we're talking about stop losses here. So as you can see, here we have the neckline, and usually many people will open a position right below or right above that neckline, and then whatever distance from the neckline to the open line, we can place a stop loss at that same distance from the neckline going in the opposite direction. So, and as we can see, had we gone long, we would have made the right decision. So, again, trading breakouts. This is an excellent way in order to determine how much profit we can make when we open a position, but only if we do it properly. And we also have to be careful when we get false readings, because just because a line of support and resistance has been broken doesn't mean that a new trend has begun. It just means that the market is being tested, but as the market's being tested, the lines of support and resistance are holding strong. Thank you for watching my videos, and good trading.